Welcome to Explain the Charts, your go-to channel for in-depth market analysis. Today, December 4th, 2025, we're putting the spotlight on the highly dynamic euro to US dollar pair, dissecting both the underlying news and the intricate chart data. The financial world is buzzing with talk of a significantly weakening US dollar, currently experiencing its worst 7-day stretch since 2020. This depreciation is largely fueled by market expectations that the Federal Reserve will implement a 25 basis point rate cut in December, with further easing anticipated in early 2026. Conversely, the European Central Bank has maintained its rates at 2% for 3 consecutive meetings, signaling no immediate urgency for policy adjustments amid stabilizing Eurozone inflation figures. Stronger than expected European Services Purchasing Managers Index, or PMI, data is also bolstering the euro, contributing to its extended gains against the dollar. We're seeing reports of positive sentiment surrounding Russia-Ukraine peace negotiations, adding another layer of geopolitical influence to market stability. Meanwhile, domestic U.S. fiscal tensions persist, with the government shutdown deadline now extended to January 30th. While some long-term forecasts for 2025 suggest a potential bearish outlook for euro to US dollar, even a return to parity, this is often tempered by short-term bullish momentum driven by dollar weakness. The Wall Street Journal reports euro to US dollar trading around 1.1644, within its 52-week range of 1.0178 to 1.1920, placing our current price near the higher end of this historical band. Now, let's turn our attention to the charts and see how these fundamental drivers are translating into price action. Looking at the daily chart, we can observe the broad trend from mid-2024 to early December 2025. After a significant dip in mid-November 2024, touching lows around 1.04 to 1.05, the pair has embarked on a remarkable recovery. Notice the series of higher lows and higher highs forming since January 2025, clearly indicating an overarching bullish sentiment over the past year. The resistance level around 1.12 to 1.13 acted as a ceiling through most of Q1 2025 before being decisively broken in April. A particularly strong rally occurred between April 9th and 11th, pushing the pair from around 1.095 to over 1.13, a move largely driven by softening US dollar sentiment amid tariff uncertainty and Fed easing hopes. Another notable surge took place in mid-September, with euro to US dollar breaking above 1.18, showcasing the market's conviction in euro strength during that period. Fast forward to the past month, and the daily chart reveals a compelling 8-day rally, as reported by the news, which culminated in a strong close at 1.1666 on December 3, 2025. This recent upward momentum clearly aligns with the narrative of a weakening US dollar and stable Eurozone conditions, as investors price in expected Fed rate cuts. Shifting our focus to the 1-hour chart, we can gain a more granular perspective on this recent rally leading up to December 3. From around November 25th, observe the consistent series of green candles, painting a clear picture of bullish dominance. We can identify strong support forming near the 1.1550 level, where multiple hourly candles found buying interest before pushing higher. The pair encountered notable resistance around the 1.1650 to 1.1680 region, an area mentioned by FX Street as a key resistance zone that the price has recently been testing. The final hours of December 3 show the price consolidating just below the daily high of 1.16776, indicating a slight pause or softening of momentum after the extended rally, exactly as the news headline suggests for today. Let's zoom even closer into the last few days using the 15-minute chart, starting from November 30th. Here, we can clearly see the choppy, yet generally upward trajectory that led to December 3 RD's strong close. The market shows moments of strong buying pressure, particularly breaking through the 1.16 psychological level around December 1st. However, in the very latest candles for December 3rd, specifically from about 1700 hours Universal Time Coordinated onwards, we witness a subtle, but definite retreat from the day's high of 1.16776. This short-term pullback confirms the softening after the 8-day rally, as buyers take a breath and market participants await fresh data, such as the upcoming US PCE index. So, what does this all mean for trading euro to US dollar in the short and long term? For a bullish short-term outlook, we would need to see a decisive break and hold above the 1.1680 to 1.1700 resistance zone. Should this occur, targets could quickly extend to 1.1728 and potentially 1.1778, aligning with previous swing highs and news-identified targets. Reinforcing this likelihood would be continued dovish signals from the Fed, further strong Eurozone economic data, or any negative surprises for the US dollar, like disappointing jobs data. A sustained breakout above 1.1700 has a 60% likelihood given the current momentum and fundamental tailwinds. Conversely, a bearish short-term scenario would unfold if the price fails to break 1.1680 and instead drops below the immediate support at 1.1650. A more significant break below 1.1600, especially if accompanied by high volume, would signal a potential reversal, opening the door for a test of 1.1550, and then the critical 1.1460 to 1.1500 support region. This bearish shift gains likelihood if upcoming U.S. economic data surprises to the upside, or if the ECB begins to hint at future policy adjustments. The probability of a significant pullback to 1.1550 is around 45% if the 1.1650 support is breached, but a full reversal to 1.1450 feels less likely at 25% given the current macro environment, unless a major news event occurs. Looking long-term, while current events favor the euro, the bearish outlook for 2025 toward parity, as suggested by some analysts, depends heavily on a reversal of macroeconomic factors and potential shifts in U.S. trade policy or Fed hawkishness that aren't yet visible. In summary, keep a close eye on the 1.1680 to 1.1700 level. Its breach is key for continued bullish momentum. Strong support rests at 1.1600, followed by 1.1550, and then the more robust zone of 1.1460 to 1.1500. Upcoming US PCE data and any new commentary from Federal Reserve or ECB officials will be critical market movers, so stay tuned to economic calendars. Remember, trading involves substantial risk, and this is not financial advice. Always conduct your own thorough research and analysis before making any investment decisions. Thank you for watching Explain the Charts, and we'll see you in the next one.